Imagine two people, same age, same city, both responsible, both trying to do the right thing with their money. The first person has $80,000 sitting in a savings account at their local bank. She checks it regularly, feels good knowing it's safe, and sleeps easy at night. The second person has only $22,000 in a savings account, but the rest of his money is deployed elsewhere. Nothing flashy, nothing risky, just quietly working in the background. 5 years later, the first person's $80,000 has grown to about $82,400. The second person's portfolio has nearly doubled. Same economic environment, same 5 years, completely different outcomes. So, what happened? How did playing it safe cost the first person tens of thousands of dollars without her even realizing it? That's exactly what we're going to unpack today. Because the investment most people run to for safety, it might be the most expensive financial decision you're making right now, and the cost is almost entirely invisible. Let's talk about the savings account, the high yield savings account, the money market account, the certificate of deposit, the treasury bond that matures in 30 days. These are the financial tools that feel safe, and I want to be very clear before we go any further, they're not bad. There is absolutely a time and a place for liquid, low risk savings. An emergency fund, yes. Short term savings for a purchase in the next 1 to 2 years, absolutely. But here's the problem: most people aren't using these tools strategically, they're using them emotionally. And that emotional decision, that psychological need to feel safe, is quietly costing them a fortune. Think about the last time the market dropped. Maybe it was a rough quarter or a scary headline about a recession. What did people do? They pulled money out of investments and moved it into savings. It felt rational. It felt responsible. But what they were actually doing was locking in losses and opting out of the recovery that almost always follows. This is called loss aversion, and it's one of the most well-documented cognitive biases in behavioral economics. Studies consistently show that the pain of losing money feels roughly twice as powerful as the pleasure of gaining the same amount. So we make irrational decisions to avoid that pain, even when those decisions hurt us more in the long run. But it goes deeper than that. There's also what I call the illusion of control. When your money is in a savings account, you can see it. The number barely moves. It feels stable, predictable, controllable. And in a world that often feels chaotic, that feeling of control is incredibly seductive. The market, on the other hand, goes up and down. It's noisy. It's unpredictable in the short term. And that noise triggers anxiety even when the long-term direction is overwhelmingly upward. Here's the thing, nobody tells you clearly enough. Stability is not the same as safety. A savings account that holds a flat $80,000 looks stable, but inflation doesn't care about your feelings. It runs at roughly 3% per year on average, some years higher. So if your savings account is earning 1%, 2%, even 4.5% on a good high yield account, and inflation is running at 3.5%, your real purchasing power is being eroded slowly, silently, every single month. That $80,000 today won't buy you what $80,000 buys you in 10 years. Not even close. And this is the trap. The invisible drain: you look at your account, you see a positive number, you feel good, and meanwhile, the gap between where you are and where you could be is widening every single year. So why do we keep doing it? Because fear is loud and compound growth is quiet. Because certainty right now feels better than wealth later. Because no one ever made headlines by slowly becoming comfortable and financially free through consistent investing. But that's exactly what we're going to change today. I want to give you a clear, actionable way to think about this, a framework I call the SAFE framework. And yes, the acronym is intentional because I want you to reclaim what SAFE actually means when it comes to your money. S, separate your safety layers. A, actively invest your surplus. F, fight inflation. By default, E, eliminate the emotion from the equation. Let's go through each one. The first mistake most people make is treating all of their money as one lump sum. It's just my savings. But not all money has the same job. And once you separate your money by purpose, everything gets clearer. Here's how to think about it. Layer 1, the emergency fund. This is your true safety net. 3 to 6 months of living expenses sitting in a high yield savings account or money market account, completely liquid. This money is not for investing. It's not for returns. It's for security. If you lose your job tomorrow, this is what keeps your lights on and your stress manageable. Layer 2, short-term goals. Anything you plan to spend in the next 1 to 3 years, a car, a down payment, a wedding, a sabbatical, should also be in a low-risk liquid account. You don't invest this money because you can't afford a market downturn to eat 20% of it right before you need it. Layer 3, long-term wealth. Everything beyond layers 1 and 2, that money has one job: to grow. And if it's sitting in a savings account earning 4% while inflation eats 3.5% of it, it's failing at its job. Once you clearly define how much belongs in each layer, something shifts. You stop feeling like investing is risky and start seeing it as a responsibility you have to your future self. The money in layer 3 has time to weather market volatility. In fact, it needs to be invested to fulfill its purpose. Action step. This week, open a spreadsheet or a notes app and calculate your 3 to 6 month emergency fund number. Then look at your current savings balance. Is there money beyond that safety net sitting idle? That's your layer 3 surplus, and it's time to put it to work. Rule hash 2. A. Actively invest your surplus. Here's where the real conversation happens. Let's talk about the actual cost of inaction because most people dramatically underestimate it. Suppose you have $30,000 sitting in a high yield savings account earning 4.5% annually. In 20 years, that $30,000 becomes roughly $72,000. Not bad, right? Now let's say instead you invest that same $30,000 in a diversified index fund that averages 9% annually, which is roughly the historical average of the S&P 500 adjusted for inflation. In 20 years, that $30,000 becomes approximately $168,000. That's not a small difference. That's $96,000 in lost opportunity. Nearly $100,000 gone, not because you made a bad investment, but because you made no investment at all. And that's just one lump sum with no additional contributions. Add consistent monthly contributions on top, the gap becomes generational. Now, I know what you're thinking, but the market can drop. I could lose money. And yes, in any given year, the market can and does decline. But here's the key insight. You don't lose money in a diversified long-term investment until you sell. A paper loss is not a realized loss. And historically, the market has recovered from every single downturn, every recession, every crash, every correction. The people who lose money in market crashes are the ones who panic and sell. The people who stay the course, or better yet, keep buying during the dip, are the ones who build real wealth. Action step. Open or log into your brokerage account this week. Fidelity, Vanguard, Schwab, whatever you use. If you don't have one, open one today. Start with a simple 3-fund portfolio or a target date index fund. Transfer your layer 3 surplus and set up automatic monthly contributions, even if it's $50. Automate it so you remove the decision from the equation. Most people think about inflation as something that affects the price of groceries or gas, and yes, it does. But inflation's most insidious effect is on dormant money, money that's sitting still while the cost of everything around it rises. Let me give you a concrete example. In 2004, the median home price in the US was around $185,000. Today, it's closer to $420,000. If you had $185,000 sitting in a savings account in 2004 earning 2% annually, by today you'd have roughly $275,000. But the same house now costs $420,000. You lost $145,000 in purchasing power while your account grew. This is why financial professionals talk about real returns, not just the percentage your account grows, but how that growth compares to inflation. If inflation runs at 3.5% and your savings earns 4%, your real return is just 0.5%. You're barely treading water. To fight inflation by default means making inflation-beating returns your baseline expectation, not a bonus. Historically, diversified equity investing has generated real returns of around 5 to 7% above inflation over long periods. That's the standard you should be holding your money to. Action step. Calculate your current savings account's real return right now. Take your interest rate and subtract the current inflation rate. If that number is negative or near zero, you have a problem worth solving. Move your surplus to investments that are built to outpace inflation over time. Rule hash 4. Eliminate the emotion from the equation. This is the hardest rule. not because it's complicated, but because it requires rewiring how you feel about money. The market will drop. There will be headlines about economic catastrophe. There will be recessions, corrections, and scary quarters. And every single time, your brain will whisper or scream, "Get out, move it to savings, be safe." You have to build systems that make it harder to listen to that voice. Here's how. First, stop watching your portfolio daily. Seriously. The more frequently you check, the more likely you are to react emotionally. Studies show that investors who check their portfolios daily are far more likely to make panic-driven decisions than those who check quarterly. Second, automate your investments. When money moves automatically from your paycheck to your investment account, you never feel the transfer. You adapt your lifestyle to what's left. This is the single most powerful behavioral tool available to regular investors. Third, reframe downturns as discounts. When the market drops 15%, your existing investments are temporarily worth less on paper, but every new dollar you invest is buying more shares at a lower price. That's not a crisis, that's a sale. Action step: set a calendar reminder right now for 3 months from today. That's when you'll next review your investment portfolio. Between now and then, don't touch it, don't obsess over it, let the system work. Now, I know some of you are sitting with objections, and they're valid. Let me address the big ones. But what if I need the money soon? This is exactly why Rule Hasson exists. Layer separation is everything. If you've properly funded your emergency fund and your short-term goal savings, then the money you're investing is money you genuinely don't need for 5 or more years. If you can't say that if all your savings is potentially needed within the next 2 years, then yes, keep it liquid. But be honest with yourself about whether that's actually true or whether it's just fear talking. What if the market crashes right after I invest? This is called sequence of returns risk, and it's real, but mostly for people who are retiring in the near future. If you have a decade or more before you need this money, a crash in year one is actually an opportunity. You'll be buying more shares at lower prices, and when the market recovers, as it historically always has, you'll own more of the upside. I don't know enough about investing to start. You don't need to. A simple, low-cost index fund that tracks the total market, or the S&P 500, requires no stock picking, no active management, and no financial expertise. You buy it, you hold it, you contribute regularly. That's the entire strategy. Warren Buffett himself has repeatedly recommended this exact approach for most individual investors. What if this time is different? It won't be. And I know that sounds overconfident, but here's the historical reality. People have said this time is different through the Great Depression, World War II, the dot-com crash, the 2008 financial crisis, and the COVID collapse. Every single time, the market recovered and went on to set new highs. Long-term investing isn't a gamble, it's a bet on human economic progress continuing. That's a bet I'm comfortable making. So let's bring it back to where we started. Two people, same world, completely different financial outcomes. The difference wasn't income. It wasn't luck. It was understanding that safe is not always safe. That keeping money still while the world gets more expensive isn't conservative, it's costly, and that the real risk isn't volatility. The real risk is never letting your money do the one thing it's capable of doing, compounding into something that changes your life. Remember the SAFE framework. S, separate your safety layers. A, actively invest your surplus. F, fight inflation by default. E, eliminate the emotion from the equation. You don't have to do this perfectly, you just have to start. Open the account, make the transfer, set the automation. Future, you will look back at this moment and be genuinely grateful. If this video helped you see your savings differently, share it with someone who needs to hear it. And subscribe if you want more content that challenges the conventional wisdom and actually shows you how to build lasting wealth, not just the appearance of it. I'll see you in the next one.